In this video, we're going to discuss carrying costs. So carrying costs are any of the costs that are associated with holding inventory. When a company buys inventory, it has to do something with it until it actually sells the inventory. And so we call that holding, right? It's holding the inventory. And there are a number of different costs associated with holding inventory. Probably the most obvious is storage. So if we have to rent out a warehouse or some kind of storage facility in order to hold this inventory, then obviously the cost of the rent is a cost of holding the inventory. So we have, think about it with your own life. If you have to rent a storage locker because you have so much stuff, that rent would be a cost. Okay. Now, once you have the inventory, companies will purchase insurance in case that, for example, if the inventory were damaged or there was a natural disaster or something, because the inventory has value, and so you want to insure it. So the cost of insurance would also be a cost of holding the inventory. And then also, if you have a security guard, so let's say you've got the inventory in a warehouse and you're storing it, and you hire a person to actually watch and make sure that nobody breaks into the warehouse or does anything. So that cost of security and actually preventing people from stealing the inventory, that is a holding cost as well. And then shrinkage, if you've never heard of shrinkage before, it could actually mean a number of things. Basically, it could be that the inventory becomes damaged. It could be that the inventory is spoiled. If we're talking about fresh fruit or vegetables, let's say that's your inventory. You can't just hold it forever, right? At some point in time, it's going to become spoiled. It also could be theft. Could be that you get this inventory, and as it's sitting there, some of the employees or some other people decide to steal it. So it could be damaged, it could be spoiled. So when inventory decreases in these ways, we call it shrinkage. Okay, so if you're thinking about like the grocery industry, they say, oh, shrinkage, 1% of our inventory disappears due to shrinkage every year or something like that. In the technology industry, a real issue is obsolescence. So whenever you're holding inventory, particularly technology-related inventory, there's a chance that there could be technological advances, and so your inventory becomes obsolete. Think about a computer. If the inventory is a set of computers, and then if you aren't able to sell those computers within a certain amount of time, and then next year faster computers come out and nobody wants those older computers or something like that. So the inventory can be obsolete. So that's the cost of holding large amounts of inventory, is that you increase the risk that someone will steal it, it'll become obsolete, and so forth. Now, and this is probably not as quite as intuitive, but there is a foregone rate of return that on the working capital that is tied up in the inventory. Let me give you an example of what I mean. Let's say that you pay $200,000 to buy inventory. And so you've got the inventory just sitting there, and let's just say that the inventory sits there for an entire year. And had you not purchased this inventory, you could have instead invested that $200,000, and let's just pretend that you could have earned a rate of return of 10%. Okay, over the course of the year, you could have earned 10% instead of having the 200 grand sit in just tied up in inventory for a year. So that's $20,000 that you could have earned had you not bought the inventory and had the inventory sit there for a year. You could have earned, or you could have had a return of $20,000 that you could have in your bank account, but instead you had the money tied up in inventory. And in some cases, that's the biggest cost, the biggest holding cost of inventory. And so if someone were to ask you, well, what is the carrying cost or holding cost of all the inventory? What you would do is you would go and add all of these up. Some companies will just say, okay, accounting for all of these different things is 6%. So it depends on what firm you work at, and so some firms might not even really closely track this. But a large firm would have very careful. They would very carefully monitor what is the cost of holding the inventory, because these costs can add up and they can be quite significant. Which is why a lot of companies have gone, or well, I shouldn't say most or anything, but there's a large, significant number of companies that have gone to just-in-time inventory systems, where the goal is to have very minimal or even zero level of inventory, so that you can minimize all these different carrying costs of inventory.